Jason Attew, President and CEO of Liberty Gold, and we're focused on oxide heap leach opportunities in the Great Basin of the United States.
Jason, good to see you here. Thanks for coming over. Busy over there at the conference?
It's very busy, yes.
Yeah. And what sort of people are rocking up, and who are you trying to see?
What we're trying to do is basically meet with all of our investors.
Right.
So we've got really good investor complement of, these are the long-term sticky gold investors.
Yeah.
And so it's been a good conference just in terms of, obviously, we got to sit down with individuals and talk about the prospects of our company and where we're going forward and the overall macro environment of the gold sector as a whole, which has not been fantastic. It's been a very, very difficult.
Well, it's 2 years,
cyclical.
Right?
It's been 3 years now.
Right.
Yes.
Okay.
Yeah.
It's been long, deep, heavy, hard work. And if you're talking to new investors, you're saying, what about gold? Get in now, it's cheap.
Yeah.
Is that the message?
Well, I think it has to be the message, although I would say the gold commodity has actually been very resilient through what arguably could be a lot of headwinds associated with it, specifically the U.S. dollar strength, because there's a very strong correlation between the two. But the gold equities in particular, because it's such a risk-off market right now, gold equities have really, really underperformed. Most of the companies that are here that are in the development or exploration stage, they're all trading from a net asset value perspective anywhere between 10 and 20% of their fundamental value. So it's been very, very challenging. But the business is cyclical.
Right.
And,
well, you got to hope. You got to hope it is. So equities disconnected from reality, it seems, of the gold price. When's it going to change? You must have a view.
Well, if I was a prognosticator of when things do change in the gold equity side, I probably wouldn't be sitting here with you because you're sitting somewhere on a beach just reveling. It's a fantastic, dynamic business industry. I think what I said earlier, really the big catalyst in my mind has to do with the U.S. dollar strength and the debasement of the U.S. dollars that, again, don't know exactly when it's going to happen, but clearly the tightening cycle with the Fed, when they do pivot, whether it's 2024 or beyond, that's when you're going to see a real pickup with the commodity in particular. And it all will start, in my estimation, with the large senior producers. And so the senior producers now at the gold price are generating exceptionally good free cash flow yields. It is a very risky business too. So as I said, this is a very risk-off environment. We'll start to see some of the capital flows back into the producers first, and then it will trickle down to companies like Liberty Gold, who've got some of the best prospects and will fill in the pipelines, arguably, of some of the seniors when they do just start to do M&A.
Right, and obviously moments like this, it's tough for everyone across the board. And it almost feels like gold equities have had it, quite good for quite a long time. But does this kind of market help shake things up a bit? And obviously for producers and developers like yourselves, do you come out the other side stronger?
Look, I think it has been. We were talking about it earlier. I think it's been 36 months now where the gold equities have really lagged behind the commodities, and the industry as a whole has had a bad reputation, and some rightly justified, around capital allocation. I do think a lot of it, and again, it starts with the seniors. I do think that from a capital allocation perspective, most CEOs, CFOs, C-suites, all the way down to the operators are making all the right decisions as it relates to the capital allocation of their business. But the fact of the matter in the gold industry, every day that you're producing successfully, profitably, and safely, you're depleting your asset base. So that does have to replenish at some point. And so, look, it's all about proper capital allocation. When things are with unbridled enthusiasm, again, the sector has been very guilty of going out and making very, very poor capital allocation decisions. So as I said, hopefully there's been some religion found. People do actually make some good returns. I'm talking the investors and the shareholders through this period. And there's the discipline that I talked about as we go forward, and hopefully we see a much more constructive gold tape.
Right, and obviously you've got producers, whether it be the big boys or some of the mid-tiers, must be looking around the market and licking their lips at some of the development stories, which are, as you said right at the outset, super undervalued on any metric.
Yes.
Super undervalued. You've got to make yourself defensible.
Yes.
Because you don't want to sell out at these prices, do you?
No, you absolutely don't.
Right. That's hard.
Well, the first thing I would say is there's not a lot of companies in that producing, again, intermediates that actually have a license to do deals based on the history of some of the poor decisions that they made, but some that do and have executed very well. There's no question they can be opportunistic in this market. So for a company like Liberty Gold, what we obviously wanted, we don't want to transact down at these levels, but at the end of the day, the management and shareholders, the management of and insiders of Liberty only own 5% of the company. So it was very, very difficult not to present an offer that's a significant premium to where we are, not to shareholders. That arguably, from my perspective, is my biggest fear, that we actually receive something. But what I think for companies like Liberty need to do is, with the quality assets that we do have, is have as many quality, credible counterparties that are up the curve on our assets, that if we do get put in play, there's some competitive tension.
Right. Essential. Otherwise, you've got no leverage.
Exactly right.
So let's talk about some of the things that you are doing, in Utah and Idaho, and maybe give us a sense of where you think the best allocation of your capital is. So
it's great, because we, on Monday, which is 3 days ago now, we actually announced a very small financing with a strategic partner, Wheaton Precious Metals. They're one of the major royalty streaming companies. So we've got an anchor order. We're raising another $700,000 through existing investors, myself, management and directors, for a total of 5.7, which will close this Friday. But what that does for us, again, we're talking about capital allocation. What that does for us, it actually gets us to the biggest catalyst for this company, and we got to actually put out an economic study, a pre-feasibility study for the Black Pine project, which is our flagship asset in Idaho. What that concurrently does is, when we actually do put an economic study out, we can actually file what's called a mine plan of operation to really start the permitting process, because that can be time-consuming in the U.S. in particular, and even know that there's a mandate now. By the time you actually put in what's called a notice of intent to the record of decision, is 24 months. We do have to start that clock. So from an allocation of capital perspective, we raised a small amount of capital. Our treasury last June 30th, we had 10.9 million. So you add the 5. We've got 4 drills in the field right now, so we have been burning a little bit of capital. But what we need to do now, from an allocation perspective, given this season, the 2023 drill season, is all about the study. It's all about, as I said, the biggest catalyst for the company, demonstrating the economics, demonstrating we actually have a mine at Black Pine, and getting into the permitting process, because it's a 24 to 36 month process. And so that's the way we're de-risking, using our capital to de-risk.
Right.
If the market comes back, we'd love to have more capital to drill out and drill our properties, including our other property in Utah. But for us, all the drilling and the work that we've done in the 2023 program, our goal is to get over 3 million ounces indicated. That will again feed into the pre-feasibility economic study that will demonstrate this is a mine.
Right. And I guess the other aspect to that particular transaction is the endorsement by Wheaton themselves, because they don't casually hand out money.
No.
But they have to do a lot of work. So, and we spoke to Randy at the beginning of the year. So we've got a sense of the kind of profile of the companies and the deals that they want to look at. So how long was that process for you?
So again, it's where we started is we obviously purchased a royalty and then essentially resold that royalty to Wheaton Precious. That's what they got out of it. And again, the asset package, the Black Pine asset that we have, is a very large, going to be a long life mine. Mm-hmm. And so the vendor that we dealt with took some time to negotiate. And ironically, we put our resource out in February of this past year that demonstrated 3.1 million in mineral and an overall resource, which that vendor did see. And so some negotiation that had to have to happen, because we purchased the royalty for 3.5. That wasn't the starting price where that group started at, much higher. But in the same respect, when we purchased 3.5, we basically then resold it to Wheaton, and this is a 50 basis point royalty, so it's not a huge encumbrance on the asset. And what we did do, which we thought was a smart thing, is Wheaton also granted us an option to buy back half of that. So it's 25 basis points to have an overall royalty interest of 25 basis points as the mine going forward for the same implied value that we purchased and then resold to Wheaton as of what we announced on Monday. So again, I think it was a creative deal for capital that we did need, a good endorsement. We consider the Wheaton Group as a great partnership now, and we'll be working with them as one of our most important investors go forward and a potential financier when we go to actually put the capital together to construct and build Black Pine.
Okay, so that's Black Pine, that's a catalyst. Should we talk Oxide?
Sure.
What's happening down there?
In Utah, or yeah, so again, most of the capital that I talked about in our work program was focused on the Black Pine asset in Idaho. We do have another asset in Utah. So again, both of these assets are past producing oxide heap leach run of mine assets, so very technically straightforward, low capital intensity. We haven't spent any real money because we're being very prudent with our capital in the Utah asset, with the exception we've done a hydrological survey to understand where the water will be sourced for that operation. In addition, what's gone on is there's a proposal between the BLM and what's called SITLA, which is a schools trust of Utah, to do a land swap. And effectively, we're part of that. We're piggybacking on the process, and it all revolves around a national monument called Bears Ear National Monument, which effectively would swap some of the SITLA land that resides within that national monument, swapping it out with the BLM land that we have at our Goldstrike asset. But the meaning would be, if and when, and it's got congressional committee approvals now at the Senate, if that does get approval, what that implication for Liberty Gold is, we wouldn't need to go through a federal permitting process. It would stay within the state of Utah.
Yep.
And so that basically halves the time. You still have to obviously prove up, do all the right things in terms of the environmental impact, but the overall time frame to get a permit is about half the time frame if you go through the federal process. So we're obviously watching what is going on there. Is something that this management can't control, but it could be a real big game changer for the company because I mean the Goldstrike assets. It has an economic study on it, but the economic study was done in 2018, so that will need to be refreshed because it is certainly dated. And it's not as big as Black Pine. What the economic study demonstrated is a 7 to 8 year mine life, 75,000 ounces per year. Black Pine is, from what we're seeing right now, conceptually, based on the 3.1 million ounces we have, is at least a 15 to 17 year mine life. Average annual throughput of about 190,000 ounces. It gets beyond 200,000 some years that we're trying to smooth that out as well. So it's not the same scale, we would argue, but the difference is the timing to actually get to production. Goldstrike would essentially move in front of Black Pine. That wasn't kind of our initial assumption if this land swap goes forward. So we're obviously very keen in seeing the development there. And so that's really the only, we're not spending really any capital on the Goldstrike asset unless and until we actually see this move forward.
Right, and talking of which, you're talking the game of staying in control of the things that you can.
Right.
You've got the capital to do that.
Yes.
Which was handy because the optionality there
Yes.
in terms of defining how quickly things happen, how quickly you spend that money. But the market is not working for anyone at the moment, right? I think we've established that.
Yes.
Why do you think it's important to kind of move things forward and not just kind of like hunker down during this period?
For us, I mean, that could be an option for a lot of either our peers or some of the smaller exploration co's. But for us, we've been an exploration company now for 6 years. We need to evolve the company. We've got, again, the scale at Black Pine of over 3 million ounces. We need to also get, as I said, into the permit. That's the biggest catalyst for the company is an economic study plus actually getting the project into the permitting process, the Federal Environmental Protection Act, the NEPA process. So we do need that. But you're absolutely right. If you think about from a capital allocation perspective, right now, most of the companies, including ourselves, I mean, between the two projects, the Oxide heap leach projects, our endowment's 4.3 million ounces. What we're being valued at on a dollar per ounce is somewhere around $10 to $11 per ounce. We can't find gold, and we're in past producing camps. Our cost to discover is about $16 an ounce. So it just shows you, if this continues, I mean, we're actually destroying value, and from a capital allocation, we shouldn't be drilling. And so to your point, I mean, there are very likely a lot of discussions going on in boards and boardrooms, whether you just shut everything down and hunker down until you see a more receptive market that values these assets appropriately.
Well, absolutely. I mean, because you talk about, you're using the word catalyst, and I think, you know, historically when you use the word catalyst, it refers to an expected change in share price appreciation. It's not happening. So that's why now when it's people talking about, well, we're going to do this momentous event, this next catalyst, this whatever, they know the market's not going to value it.
Yeah.
So to a larger or less degree, you kind of maybe shrug the shoulders and go, why do I even bother?
Well, we're in it for the long game. And as I said, for us, it's the most consequential things we can do is de-risk the Black Pine. And so we do need to get in the permitting process. Right. Because that does take years, at least a couple of years. And so can't imagine this market's going to be, you know, from a macro perspective and, you know, this challenging, if you think 2-3 years, and if it is, there's going to be a lot of blood in the street.
I think the interesting thing you said earlier was about the fact that obviously these majors or producers are going to have to backfill because they're depleting their own reserves and resources themselves. Do you think at that point, because this shakeout that's happening, right? There's some good assets out there, good development assets out there, which are not making any progress because they can't get capital, or if they feel that if they do take capital, it's super, super expensive and they're going to get burnt some way. Do you feel there's going to be a kind of premium in terms of that competitive tension discussion for more advanced projects for some of these, you know, majors? Are they going to view the near terminology of it as important?
I think it's honestly, but I think it's case by case. It really will depend on jurisdictions. For one, it really depend on the seniors and intermediates pipelines. Some of them have very good organic pipelines, some do not. And some have a certain skill set around certain types of mines and how processing and some of the technical acumen that's required, and others do not. So I think it's definitely on a case-by-case basis. But what I've typically seen, being 30 years in the business, it's very, very challenging to do, even if you're a senior or intermediate, to do. And there's, as I said before, there's very few companies that have a license to do deals. And a lot of this is driven by sentiment. And so the sentiment is not good in the sector right now. But as soon as we see a change in sentiment, all the boards of the various producing companies are going to be asking, well, what's the next stage of growth here? How are we filling in our pipeline? But you do need some momentum. You do need some positive sentiment, with the exception, as I said, with a few companies that do have a license to do transactions down here.
But I think that's kind of certainly true for the last 30 years or so. But I think, remember, gold price is pretty darn good at the moment, right?
Yeah.
So in terms of that discussion at board levels, at those producers, wouldn't you be thinking, listen, I'm going to get cheaper than this? Surely, look at the gold price, because what we want is producing ounces, because we're selling it at quite an attractive rate at the moment. So I'm trying to make sense of the gold market. Okay? Normal rules, as a banker, normal rules, I would have had a whole set of things that would happen. I know what I could do. If this happened, I can do A. If this happens, I do B. It doesn't follow those rules anymore. And I think, do people need to kind of rethink the way we view gold and gold mining?
Like, I think the gold mining business, and I worked for a producer for a number of years. It's a damn hard business. There's things that operationally can go. So it requires some really good operational expertise and excellence and acumen. So that would be kind of the first point. And so the other thing that I would say is, again, the companies that are, even though we've got a pretty robust gold market, they're still facing a lot of inflation. So their costs have not abated. And so the margins that I talked about earlier, even though they're getting good free cash flow yields, when the inflation starts to temper, and it's already started to happen, those margins should hopefully expand, which will create some of the momentum, as I said. So it becomes a little bit of a self-fulfilling prophecy. But the gold market's got a great future. There's no question about that. There's very few discoveries being made. again, from the seniors to the intermediates, they do have to replenish their pipelines, and if they don't have a lot of organic properties and projects in house already, they have to. And we're seeing that. We're seeing engagement with seniors and intermediates with companies like Liberty.
Yeah. Well, look, appreciate the update.
All right.
Good luck with the rest of the conference.
Thank you very much.
I know you're pretty stacked with meetings and so forth.
Always happy to do this, Matt.
Good man.
Yeah.
See you soon.
Good stuff.